So we're looking at the role of short-termism for corporate investment. And I think looking at the investment, in particular long-term investment, is very important because eventually if you want to have economic growth, economic development, then what you need is that companies take risks, take long-term investments. Think of R&D. R&D is very important for the long-term success of economies, but R&D is very costly because in order to have good innovation, you first need to spend a lot of money. And so the fruits of your investment will only arise in the long run, but in the short term, spending on research and development depresses your earnings because you have to expense the money that you spend on R&D. And so in the short run, there is a burden, all these expenses, and the benefits of your investments only arise in the long run. If firms want to be successful in the long run, they need to spend a lot on research and development. And so what we are particularly interested in is to what extent short-term investors, so investors that arise and that are present in the firm only for a relatively short period of time, whether such investors cause firms to cut investment, to behave more short-term. And why would they do this? Well, if you think about the incentives of short-term investors, they enter a firm and they know that they want to leave in the short run. So they have an incentive for firms to cut long-term investment, therefore report higher earnings. And if the market doesn't understand that the higher earnings are only the result of cuts to long-term investment, then this may lead to bubbles in the stock price. Because we know that sometimes markets misunderstand higher earnings, so that may lead to higher reported earnings and therefore higher short-term valuations. And if you're a short-term investor, you can exploit this. So you enter the firm, you make the firm cut investment, and then you benefit from the short-term higher stock price and leave afterwards. So you lock in the higher stock price and then you exit the firm, and only in the long run, the long-term shareholders will suffer from the cuts to long-term investment. So what we are thinking about is investors that come in, spend maybe half a year in the firm, and then immediately exit afterwards. So the exit needs to be relatively short term, because what we show is that investors come in, they cut investment, the firms cut investment, the stock price shoots up, but it only remains high for 1.5 years. And then it goes down again. So you can only exploit this as a short-term investor if you have a horizon that matches this kind of bubble in the stock price. So from half a year maybe to 1 year, and then you need to already leave again. So this is what we find. Why do managers cut investment? And one reason is that often managers are incentivized by stock options and by restricted shares that put a lot of emphasis on short-term performance. So think about stock options. So if you're a manager and you're compensated with stock options, then of course naturally you have incentives to push up the stock price because then they're more valuable. So one way how you can achieve this is you go and cut investment. So then you can report higher earnings. And if now the market doesn't understand that the higher earnings are just the result of cutting investment, the stock price may shoot up. Now you can benefit from this as a manager by exercising your options, selling the equity, and sort of locking in the bubble in the stock price. And then the market will only learn in the long run that the higher stock price is due to you cutting investment, but at that time you as a manager, you have already locked in the profits. Now, of course, from a corporate governance perspective, we know that managers have incentives to behave myopic. So therefore, when we design compensation contracts, we try to make sure that they care about the long run and therefore also take more long run investment. One way you can achieve this is by having so-called vesting periods. So we give the manager stock options and we say for the next 3 or 4 years, you cannot exercise these stock options. So therefore, the manager knows if I now cut investment that lead to temporarily higher valuations that are corrected in the long run, again, I do not benefit from this because I have to stick around for at least 3 to 4 years because I can't exercise my options beforehand. So one important mechanism to achieve that managers care about the long run is by giving them options or restricted shares that have vesting periods that are long term. So one interesting question here is, why don't markets understand that if firms cut investment, this is not good for them in the long run? Why do we see that there's a cut to investment and in the short run, the stock price increases? Well, one possible explanation is that there is information asymmetry, that the market doesn't understand that cutting investment is bad for the firm in the long run and only temporarily increases the stock price. And we have a lot of evidence that it's very hard for the market to understand research and development expenses, right? So there's a lot of misvaluation when it comes to R&D. So if you have this information asymmetry, i.e. the market not understanding that reported earnings are just due to cutting investment, then this may cause these temporary bubbles. And we have some evidence consistent with this actually. We find that results are stronger if you have few analysts that are following a firm. And analysts we use as a proxy for the information environment. So if you have very small numbers of analysts following firms, this means that a firm is more likely to get away with cutting investment and causing temporary rises in the stock price simply because of reporting higher earnings because of cuts to long-term investment. Now, in addition, another mechanism that is usually quite important is limits to arbitrage. Because you can say if there is a misvaluation, right, the stock price being too high because the market doesn't understand that it's due just to higher earnings that are due to cuts to investment, then for this to be more long-term, this misvaluation, you need to have some limits to arbitrage so that it's difficult for smart capital to come in and exploit this by basically short selling these firms. Now, this is one explanation why we see the bubble in the short run. It disappears eventually after the short-term investors have exited, but it is still around for some time. And also in the data, we have some evidence that this misvaluation, these bubbles due to cuts to long-term investments are more prevalent among firms where we believe that there are limits to arbitrage. So the issue of short-termism has become a big issue these days because we've seen that there's more and more equity ownership by institutional investors. So a large chunk of ownership in firms is held in the hands of institutional investors. And we also know that quite a few institutional investors held the stock or hold the stock only for the short run. So therefore, it's particularly important these days to understand what the effects of these short-term investors are on long-term investment, on corporate governance in general. And it's not necessarily bad to have short-term investors. We know also that they can have a disciplinary role. So if you have lots of investors that are willing to also sell the stock, if the governance in a firm is not good, then this has disciplinary effects also on the executive team. They know that if they don't act in a shareholder value increasing way, that lots of investors may exit. They're only in there for the short run if value is not increased, and this potential threat to exit the firm can cause managers to behave and to increase shareholder value. So it's not necessarily a bad thing to have short-term investors. Now, in our specific context, we do find that when it comes to long-term investment, then we have to be careful. Having too many short-term investors come in can potentially distort long-term investors. So suggesting also for boards to pay a lot of attention when short-term investors enter.